Makes you wanna go. Makes you wanna go. Na 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 na. Makes you wanna go.
And this is every single time.
Hey, Mickey G, how are you, sweetie?
I'm good. How are you, Golden Bronze? It's good to see you.
Yeah, man. Okay, everybody, y'all gotta hear that every day because we love our own intro. Okay. Thank you, everybody, for tuning in to Get with Go to Bronze. We really do appreciate it. Isn't it nice to come every day to see people in such great moods? Well, this is us every day, and we
Yep.
thank you for tuning in. We have a special topic for you today, and it is called Real Estate Basics in the United States. And I thought that would be a good topic for some people because buying property in the United States can be rewarding, but it's a very complex process. And here are some real estate basics. And it's from an expert because I am a realtor of 19 and 3/4 years. So I kind of know what I'm talking about. So let's get to it. Mickey G, if you have any questions, you can stop me at any time. All right. Alrighty. So, first thing that you need to do is to check your credit score. A good credit score is typically 620 or higher. It is crucial for securing a mortgage loan. Now, most FHA loans you have to have 620 to 630. They do have some loans that 580 is about the lowest that you can go, but those are not FHA loans. A down payment normally would be about 3% of the total cost of the home to 20% of that property price of the home. An FHA loan may allow as low as 3.5%, while conventionals require more. Now, a conventional loan is like an 80/20 loan where they may give you 80% of the cost of the house. And that's where that 20% that I just mentioned comes into play. You either have to get a second or have that 20% down payment. So most first time home buyers go with the FHA loan with the lower requirement of 3.25 to 3.5% down.
Okay, I
Any
have a
questions
question.
so far?
Yes.
Mhm.
You said you could do a second. Could you clarify what a second is on the 2080?
Yes. So on a conventional loan only, you'll have a primary loan that will cover 80% of the cost of the house. So say the house is 100,000. We know they cost way more than that. Say they are. So your first loan will pick up $80,000. You can get a second loan to that same loan process, which covers the 20% or maybe 15%, and then you put down 5%, which makes up 100% of the cost of the purchase price.
Can you typically get that from one lender, or do you have to shop lenders? If one lender will only give you 80%,
You
you
have
need
to
to
get a
find another
second.
lender for the other.
Yes, absolutely. And your debt to income ratio matters a lot. So you might have excellent credit, but you have a lot of debt. That might not get you that low interest rate that you're looking for. Lenders usually prefer your debt to be 43% of your total income. Include the mortgage, the property taxes, and the homeowner's insurance and the maintenance costs into the cost of your mortgage. So if you have $2,400 a month mortgage payment, property taxes are $500 a month, which they usually will include that into the mortgage if you have, a loan. Homeowners insurance and maintenance fees. Make sure you can afford what that total amount is. It might be $3,600 a month or 37. Make sure that not only with the mortgage can you afford the property taxes, the homeowners insurance, and everything to keep that home. That's before you ever buy the home. Do the math on paper so you know what you need to buy versus what you can afford to buy. Now, what I mean by that, they may qualify you for $500,000 because you have good credit to debt ratio. But if you can't feel comfortable paying for a $500,000 home, but you feel more comfortable with 350, you go for what you feel more comfortable with. You do not have to buy a home for the amount that you qualify for. That's very important before you ever start shopping for a home. Fixed rate mortgages are interest rates that remain constant over the term of the loan. And you can get a 15-year loan, a 20-year loan, or a 30-year loan. Most mortgage companies will start you off with 30 years. That's more money in their pocket. But if you think that you can pay that off and you want to pay the note for a 15-year loan, that's what you can ask for. But I know how you can pay that 30-year loan down, which would be a lower monthly payment off in 15 years if you want to, because that's what I did. There's a way to do it without paying the higher mortgage required to do it in a 15-year. Got any questions?
Do tell. How do you do that?
Okay, so you get a 30-year loan and your payment will be lower. But if you can afford to make two payments or $1,000 more, you make two separate payments. One for the regular, there's two ways to do it. One for your regular mortgage payment. You write a check for that or you pay that online, however you do it. And the second one, for the extra $1,000, you indicate that to go to principal only. So it knocks down the principal. So you don't make an extra payment. You make that just for the regular payment. You indicate principal only. So it knocks that 100,000 down to 90,000, faster. And that lowers your payment to when you get to a point where you can double up on them completely one time. The other way that you can do that, and this is sometimes you have to get permission from your mortgage company. You make half of the payment on the first, which say if your payment is 2,000, and the other half on the 15th is one payment, but it counts as two, which cuts it down faster. So
Cut
those are
them in
two.
half.
Yes.
Oh, that's pretty interesting. No, I know a lot of people probably didn't even know that.
No. That's what I did. I made those extra payments every month. I made the regular payment on the first of the month and the extra payment on the 15th of the month, and indicated for the extra payment to go to adjustable rate government-backed loans in just a moment when we come right back. All right. Thank you for returning. So we also have the adjustable rate mortgages, which are lower interest rates that can change after a fixed period of time. Now, I don't recommend those because they can get out of hand, but say they start you at a 3% interest for the first 2 years and you pay that and you're comfortable with that payment. Well, the third year, it could be double that. It could be 6% interest. Well, now you got a payment that you've gotten comfortable with the lower one. That second one can be quite taxing on you. And depending on how that is written, it may go up a third time to maybe 7.8 or 9%. Now you can't afford the house. So even though you got in the house and a lower rate for the first couple of years, it can get out of hand where then you can no longer afford the house. And then they have the government-backed loans, which are what we talked about, the FHA, the VA loans, and the USDA loans that have lower qualifications in order to get those loans. The benefit of the USDA loan is that usually they are in rural areas, out away from the city, kind of in the country, but close enough to the city that you can drive. You can get lower interest rates with those. The VA, the benefit of that is sometimes they don't have any down payment. The interest rate might be a little higher than an FHA, but they get in not much, just a little, but they get in with no down payment. Sometimes $1 down, sometimes $0 down if they're vet. And the FHA loan, the benefit of that is twofold. There's a lower interest rate with a smaller down payment, and they have programs for first-time home buyers where they assist you with the down payment program. So those are benefits.
I have a question. When you were
Okay.
talking about adjustable rates as opposed to fixed, I was always told when I bought my houses to have fixed, and I think that's smart. On
Yes.
the adjustable, do they tell you in the contract how many times the interest rate will go up and how high it will cap when it does go up and how often?
Yes, ma'am. They do that. It's written in the contract, but a lot of people they want the house so badly that all they can see is what it costs for the first 2 years, right? And they tend to forget that the third year is going to double, and the the second year is going, after the 2 years, is going to double, and then it'll get higher if it's written that way in the contract. Most of the times it's tri-level too. You start off with this, then it goes to this, then it goes to this. And when it gets up there to that higher limit, a lot of people end up losing their homes or walking away. And that's why you were given the advice to get a fixed rate, because that adjustable rate also depends on what the interest rate goes up to be. Uh, you know how it fluctuates, and sometimes it can spike way up. Then you can end up with a much higher interest rate than you could ever dreamed of with an adjustable rate mortgage. It's based on the market. Yep. So you were given great advice. Now, when we choose a property, we have to choose the right property. The primary residence is a home where you live. So if you are going to want to rent it out, it would not be considered your primary residence. And things are considered like your taxes, your insurance. That's taken into consideration if it's a rental home. Investment properties, those are the rental homes. And sometimes people buy those investment properties and flip them. So they buy them for the purpose of fixing them up and reselling them. And there are different types of loans for those as well. Then you have the vacation or the season home. This is where you live in it part time. You live somewhere else. So you have two homes and you live in one season and the other season. And it's many people that buy homes like that too. If they want to separate their residences, they want to live they call them, what do they, snowbirds. They live in the cold area in the summertime, say up north, and then when it gets cold, they go south to like Florida, so that they're always in the temperature that they desire to be in. Now, in order to buy a home, it is best, you don't need one, but you should. It is recommended 1000% that you hire a professional like a real estate agent who helps you find the properties. You simply tell the real estate agent where you want to live, the type of home that you want, and how old the house is, the amenities and things like that. The realtor will negotiate the price for you. It could be higher than what you're wanting to pay. The whole objective is everything is negotiable. And the real estate agent also navigates the contracts to make sure that everything in the contract is to your best interest. A lot of times, if people try to buy a home without a realtor, they miss those things in the contract. And then they retrospectively go back and try to find a realtor, help them get out of it. But most of the time, that's not going to happen either if they didn't help you with the initial contract, because we are liable and responsible legally and ethically for everything that we say and do to our customers and our clients. We don't like to pick up things when it's in trouble and try to fix them. So get you the realtor up front. All right. As far as what the realtor pays, that's between you, the realtor, and the seller. Mortgage brokers also assist in helping you find the best loan. You talk to the mortgage broker, you tell them, I don't want an interest rate over whatever, and that's going to be based on your debt to income ratio and how much you want to pay for the house. And a good mortgage broker will give you several different scenarios on what type of loan best fits your needs. And sometimes in some states, you need a real estate attorney, and that person advises you on legal documents in that state. Now, in some states, like the one I live in, the realtor does that. But then there are states like Atlanta, Georgia, I think you need a real estate attorney and a realtor to handle your purchasing of a home. But in some states, the realtor is educated and qualified to handle some of those matters within their expertise. They will not give you legal advice. We take classes called legal law and ethics. So we know a little bit about the law in our states that we're licensed in. Any questions before I go forward?
Quite interesting. So, when you're looking for a realtor, is there a database that you can go on to see what their history is, their ratings are? Is there a database that you can go, or are you just basically Googling it?
No, you can Google, because if you Google me, I'll pop up. I'll pop up in my reviews. You can Google any realtor that has a history of selling homes in that state and get that information. Not only that, you can go on Zillow. Zillow will tell you about realtors. And you can go on realtor.com and put in the realtor's name, and it'll give you the history on that realtor. Just name. And we will be right back. All right, all right. Thank you for coming back. So, after you get the realtor, you can use platforms like I just mentioned to my co host, Zillow, Realtor.com, or local listings to find properties or to find a realtor. And oftentimes, you can, even if you have a realtor, you can search for properties and let your realtor know that you're interested in that property, because the realtor in her database can see more about that property than you can see. So they make certain listings, only certain amounts of that open to the public, and then the other things are only a realtor or a broker can see about that property. The realtor also will help you find properties, and different realtors do that different ways. You could also attend some open houses, secure them to get a feel of the market. And then if you find neighborhoods that you're interested in, you can tell your realtor that, and they have a way of searching for properties in certain subdivisions or zip codes or neighborhoods as well. Once you find the property, your realtor will get access to it. Regular customers or clients cannot access a person's home without a realtor. Um, if it's a occupied home by a credible seller. Now, sometimes you'll have these big box realtors like Open Door or Next Door, whatever, that they'll give you the access, but they have cameras where they're watching you all through the house that's not visible to you, but they, trust me, are watching you. And so you can go through those as well, but you don't have a realtor to represent you because they handle the whole thing from your offer to the closing. And they are going to look out for the best interest of the homeowner, because that's who they're contracted with to sell the house. So when you have a realtor, your realtor's responsibility is to look out for your best interest, not even your realtor's best interest. So everybody involved in a transaction should have a realtor to represent you. Your needs come before your realtor's needs, and your realtor only does what you ask them to do within the law, and that's ethical. If it's not legal or ethical, he or she is not bound to do it. And then you make the offer. The offer should include the price of the home, the contingencies, those are the negotiations that you work out, inspections and appraisal, and financing details. Sellers may accept the offer, or they may counter the offer, or they may reject the offer. It could go either way. So that if they reject the offer and there's not another offer on the table, you can counter the rejected offer. And you guys can keep going back and forth as long as the seller deems it's a fair offer. But the seller, once rejecting the offer, does not have to accept a counter offer, as long as you understand that. They can say, this is what I want, and that's it. And either you accept their offer or find another home.
So what's the biggest mistake that a home buyer would do in negotiating a price or making an offer?
Doing it without the help of a realtor, that's the biggest mistake.
They
Because if
should.
you go in without a realtor, the other realtor or the seller are not obligated to you. They're obligated to the person that's, you know, commissioned them to sell the home. And you need either to have some negotiating skills or know how to negotiate a sale of a house. But the number one mistake is trying to do it without a realtor, okay? Or a real estate attorney. Have one or
Have,
the other.
when you have the realtor, odds of you shooting too low are going to be thin. I would think that you can insult a seller by offering too little, and then they won't consider your offer, and then the negotiations would end at that point.
That's absolutely true. And I would hold your realtor responsible if that happened. Because if you make an offer, realtors take an oath to make a reasonable offer. That is the verbiage to the seller. And if your realtor makes an offer that is unreasonable, it's a ding against them more so than you, because the realtor's obligation to you is to say you need to make a reasonable offer. This is going to insult the seller if you make this offer this low. Everybody thinks their house is way worth more than it is, but to make an unreasonably low offer is insulting to the listing agent and to the seller, and they don't have to consider it. They may never answer you. They don't even have to say I decline this offer. They can just trash it because you've insulted them. Yeah. So you're absolutely right. Once that realtor makes the offer, it stands until you hear back from, like you can't make it, then come back 2 days later and lower the offer. It doesn't work that way. So, but your realtor's responsibility is to educate you on what a fair offer is for the listing of that house. You know, I had somebody one time ask me to go down almost half the price of a home, and I said, I won't do that. That's an unreasonable. And the other realtor's gonna look at me like, where did you come from? That you would even think a person would accept half of their sales price. So I had to tell my client that's an unreasonable offer. And it's not fair to me or to them for you to expect somebody to sell their house half of what they have it listed for. She wanted half, wanted to buy it for half. I wouldn't do it. I'm not doing that. So we eventually went different directions because she didn't buy the house. And I don't think she got any realtor to do it. So after you make the offer, and it's accepted, that's called executing the offer. Now it goes to the title company, and the title company takes over at that point as far as checking the title to make sure there's not a second loan on it, all those kinds of things. While the title company is doing their part, then the realtor of the buyer helps them set up the inspection, which identifies potential issues with the property. Now, if it's just aesthetics, that's not expected. Like, I want the whole house painted. That's not something that you can expect a seller to do. But if there's issues with electrical, plumbing, or foundation, structural damages like that, then the seller would be expected to either, repair those things, make them right, or give the buyer compensation, decrease the price, or at closing give them 5,000 or whatever, to be able to pay for those things themselves. And often that happens where they negotiate, okay, after closing give me 5,000 and I'll take care of it, or 2,000 or whatever. So you can negotiate that while it's in the inspection process, which is usually 5 to 10 days after the offer is executed. If you don't do it within that inspection period, you just bought your house in whatever condition it's in. You have to no, you have to mention, and we'll wrap this up in a few minutes. You'll have to mention what you need fixed before that time period is up. And we will be right back. All right, all right. Thank you. We're back. Okay, so let me take a pause. Do you have any questions?
I do. So when a property is in ill repair, does a bank sometimes consider that as to whether they'll do a loan on that house or not? Does that cause it sometimes to not be accepted for the bank?
Absolutely. If that property is in really bad care, situation, they will not. They will want the homeowner to make the improvement because they are taking a risk on mortgaging the loan. So the house really belongs to the bank until you pay off the mortgage. And so they absolutely will either say this has to be repaired or we will not finance the loan. Yes. Anything else?
At this time, I'm good.
Okay. So after we get the inspection and all parties have looked it over, the seller has agreed to fix whatever needs to be repaired, or they have given some sort of compensation uh, for the buyer to fix it. We go to the appraisal process. Now, the appraisal confirms the property's value for the lender. So if you've agreed to buy the house for $500,000, but it only appraises for 400, the bank is only going to give you the $400,000. It's up to you to come up with the $100,000. Now, you can't say, oops, I don't have the $100,000, so I can't buy the house, because you are in a contract. So you have to try to figure out what you're going to do. That's why you should never buy a property without knowing the value of the property. And that is your realtor's responsibility to say, this house is not at market value for $500,000. They might love their home and they might want $500,000 for it, but it's not worth it. So don't make an offer on this house. They're not going to say make an offer for 400,000, because the realtor can't do that. But the realtor can tell you if the house is overpriced and recommend that you not buy it unless you have the extra money to pay for what the bank won't finance. And a lot of people don't know that. They think that the bank will give them whatever it is that they qualify for, but the house has to be worth it. Make sense?
Yes, it does. I had a question, but anyway, it escaped me. I know what it was. So you don't make an offer until after the appraisal is done, or you don't make the offer until then because you don't
No,
know what it's worth.
nope, not what I said at all. You
Okay.
have to make the offer in order for the seller to take the house off the market. In order for there to be an executed contract, you have to do your homework, you and your realtor, before you make the offer, to know what houses are selling for in that neighborhood. So it's called a comparative market analysis. And your realtor should do a comparative market analysis on any home in any neighborhood that you're interested in, to know what the houses have sold for in the last 3 to 6 months. Just because someone asks for 500 grand doesn't mean the bank is going to finance it for 500 grand. Just because you qualify for 500 grand doesn't mean the bank is going to give it to you. The house has to be worth whatever the mortgage company finances it for. Now, if you happen to have 100 grand extra laying around and the house is only worth 400,000, yeah, you give them 100 grand and buy that house, finance the 400. But that's not smart. Who would do that? Buy a house and pay 100,000 more than what it's worth. So yeah, you have to have your realtor do some homework with you. And that being said, there's a few things I want to say. You then finalize the mortgage, you close the deal. Again, closing costs on top of the down payment is usually typically 2 to 5% of the purchase price. So not only do you have to have 3.5% down payment, you have to have 2 to 5% also for the closing costs, which can also be negotiated with the seller, the amount, some of it or all of it. You sign the documents and then you transfer the ownership. Maintain the property and keep up with mortgage payments. Consider insurance for additional coverage like flood or earthquake, and you're good to go with buying your home. And I hope that this helped everybody and anybody out there that is not already a homeowner looking to buy a house. And I also want to say thank you for tuning in to Gab with Gold and Bronze. We hope that you come back tomorrow or the next day and the next day and the next day, because we always will have a great topic, informational, educational, spiritual, uplifting, entertaining, or just simply our opinions about the matter. We will be right back here tomorrow with a special guest or a special topic, and we ask that you come back to Gab with Gold and Bronze. And thank you for tuning in. We appreciate it.